Then that's good. So press it and I'll count to 4, okay?
Go for it now. You're on.
Well, good evening, everybody, and welcome to the January 2026 Investing Roundtable. It's 1 week late because we had an emergency last Tuesday, and that emergency took precedence over everything. I really want to compliment most of you for being able to go with the flow, listen to the emails that my lovely wife Natalie sent out, and understand that it was unavoidable, and we gave you directions. And you know, I only got one email from somebody that was confused by the whole process, and I'm really feeling good about that. I'm joined this evening by two of our regular nights, Cy Lynch and Mark Robertson, and our special guest, Matt Spielman from the Houston chapter. Matt is becoming a semi-regular night. Maybe we'll promote him to a full night one of these years. Okay.
Squire.
A squire. I've been watching this program on TV called Night of the Something or Other. It's a program that follows a prequel to the huge Game of Thrones program that used to be there. It has quite a bit of humor attached to it. It's also a little bit raunchy in places, but I think you all, if you like knights and everything like that, you might really enjoy it. It's called A Knight of the Seven Kingdoms, and you might enjoy it. But enough about something like that. It's February 3rd. It's cold outside. That's the beast going to challenge all of us this evening.
Michigan winter, but Michigan winter is in South Carolina right now, I think.
Well, it certainly is Michigan winter up here as well. We're going down to actual temperatures below 0 this week, and they're going to stay there for a couple, 3 days. And we have more snow on the way Friday and Saturday, guys. So, Mark, you prepare, I'll prepare, and you guys that are down south, cross your fingers that it doesn't reach you. Let's go to our disclaimer real quickly, if we could. Everything we say tonight is for educational purposes. We are talking about real stocks in real time, but we're not making any recommendations for you to buy, sell, or hold. The studies that we present are our personal opinions of what the company might do. These are our own analysis. You do your own analysis and draw your own conclusions about the stocks we're talking about. If you'd like to be added to our guest list, that little green box that says subscribe, if you'll go to that URL and then scroll down the page, you'll find a very short form you can fill out, and then hit the subscribe button, and you'll be added to our guest list, and you'll be on that list of over 2,500 people that we advertise the Mid-Michigan programs to throughout the country. If you'd like copies of the slides, email either Mark or myself, and if you have questions or anything about the slides or ideas about what we might do at future roundtables or future bull sessions for that matter, email both of us. We like to get mail, and we do answer our mail as quickly as we possibly can. Anything to add to this, Mark?
Nope, I think we're good.
Okay, well then let's go on to the next slide. You've all seen this slide if you've been at roundtables before, and this is tracking our efforts at beating the market by at least 5 points. That's the overriding goal of almost everybody that's in an investment club. You've heard of the 15% return over long periods of time that George Nicholson way back in the 40s suggested that a club can do. And that's still the goal that most of us are searching for and trying to reach. It's a very aggressive goal in the last 20 or 30 years, as dividends have gone from over 4% average to down averaging now just about 1.25%. That's a lot of ground to make up in meeting that goal of beating the market, and the goal has become a little bit more difficult in the last 20 or 30 years. You can see that in our most recent month, we've managed to begin to move in the correct direction again. The most recent dot represents beating the market by 2.4%. Our goal, beat the market by 5 points. That would put us at 15, and the average market's at 10. That's where that 15% comes from. The 2.4 right now is our rate of return in the last 16 years, and it's been 16.4%, minus the rate of return of the Wilshire 5000. That's the benchmark we use, and it's been pretty aggressive in the last 16 years. It's been advancing at 14% a year. So 16.4 minus 14 gives you the 2.4 relative return. We're also aiming at a outperformance accuracy of somewhere around 55%. We've done quite a bit of work, and we've sourced a lot of information, some of it from sources you wouldn't believe have anything to do with investing, but so much of our information points to the fact that when you're doing a repetitive task, you only have to be correct about 55% of the time in order to win whatever the task happens to be. A good example would be Roger Federer, the tennis player. And Roger Federer, over his career, only won about 55% of the points that he played in tennis matches. But his overall victory number of wins in matches was just way, way higher than that 55%.
89% or something like that.
Mark has the number in his head. He's a tennis buff, and I just deal with it academically, that's all. So our outperformance accuracy right now is just under 40, and we're trying to boost it back up again. We've had kind of a rough couple of years, because I can remember a time less than 2 years ago when we were above 50. So we've our outperformance has sagged a little bit, maybe along with the fact that we're a little bit below the orange line, which represents our goal of beating the market by 5 points. You've seen the graph before. If you have questions about it, send it to us at our email addresses, and we'll be glad to talk with you about it and give you some references to articles that really discuss some of the things I've been talking about just very, very briefly. Let's go to the next slide, if you would. And here's the top, I think it's the top 20 holdings from the roundtable. This is not the kind of portfolio that we would recommend a club try to put together. This is a tracking portfolio, and it keeps track of all of the things that we've said we liked at all of the roundtables in the last almost 16 years. Okay, so it has quite a few more positions than you would have in a personal portfolio or a club portfolio. But we can still track the performance of this portfolio. And I gave you that number just on the last slide. It's more than 16% annualized. Our largest holding is up there at the top. It's Microsoft, and that represents $5,000. When you pull up this portfolio, the entire thing, at the URL that's at the bottom of the page, you'll find a legend attached to it, and the legend will tell you how many times each one of our holdings has been added to the portfolio. Cognizant, for example, used to hold the top spot. I think we added it 12 times to the portfolio, and Gentex, I think, took over that top spot just at the last roundtable. I think we've added that 13 times to the portfolio right now. Microsoft, $5,000 invested, value as of closing of trading, I think tonight or last night, one of the two, about 90 some odd $1,000. And you can see by the next slide that of the 900 roughly selections that are in the roundtable, 209 of them have terminal values, have actual dollar values right now of less than $1,000. So that leaves 691 that are positive. The cumulative loss for all the 209 positions is just over $67,000. The gains from just Microsoft alone are about $97,000. So one position that's positive balances out all of the losses and leaves 690 other positive positions to give us profit. I think this slide should go up before every single club at least 2 or 3 times a year to convince them of the fact that if you can hit 1 or 2 home runs over your entire investing career, you can probably be assured of having profit in your portfolio. Let's go to the next slide, if you would, Mark. And Mark, why don't you take this one, okay?
Okay, we did a 3-part series this past weekend. We called it the Jamboree. It's basically taking a bunch of club portfolios and walking through them during our Saturday session. It was very well received. And basically what you see on the screen here is a quick summary. The sales growth forecast, the average sales growth forecast in those portfolios was 11.8%. That's a fairly substantial improvement from where it might have been 10 years ago. And part of the session that we talked about on Thursday and on Saturday is you might want to take and nudge that up even a little bit higher. 12.5, make it a target of 12.5%, for example. And the reason we say that, here's your evidence. These are the top performing mutual funds and ETFs out there. These are the top 20. Notice their average sales growth forecasts. And you'll see that they are consistently in that 13 or 14% range, with a couple exceptions. Better investing clubs have excellent quality portfolios. And the other thing we wanted to make as a point is the return forecast is down to 9 on average for these 18 clubs. But I want you to notice that the return forecast over here for these high achieving funds is also there. You're not alone. If you're in that position of being in single digit for your return forecast for your portfolio, just double down your efforts to find promising qualified candidates for the portfolio. You're not alone. Growth matters. And again, this is just one of the summary slides that I thought was fairly compelling and supportive.
Mark, it doesn't have anything to do with these slides, but we're getting a question from our audience about when does the groundhog competition, when's the last time you can send in an entry for that competition? Can you speak to that just a little bit?
Oh, absolutely. It's already started, but if you send a submission with perhaps a gift certificate to Portillo's or something like that, we'll slide your entry in. So if you still are interested, whether an individual or a group entry from an investment club, send an email to me, Mark R. at manifestinvesting.com, and I will try to sneak you in the side door without Kurt noticing. So it's officially closed, but I know how this goes. It's a busy time of the year. And what else are we going to do with all this freezing temperatures and cold? Send me your 5 to 20 stock picks, and we'll get you in the contest for the coming year. We had a blast talking about the results from 2025 this afternoon.
I think it's worth a mention that in that group of over 200 entries from last year, the average portfolio performance was somewhere north of 25%. And we had the top 100 entries that were performing in the high 20% all the way up to as high as 80 some odd percent. So we're getting some pretty good stock pickers, and you have nothing to lose because the entrance fee is nothing, and the prize is a pat on the back and a little bit of public recognition. So it's a fun contest. You send in your stocks. You don't have to do any trading or moving them around during the year because it's not allowed. And at the end, we'll tell you who came out on first. Meanwhile, we'll take a look at that contest once a week at the bull sessions, and you can have some really good fun, good clean fun with a friend. you know?
There is a rumor floating around that a Ferrari might be in the works for the winter for next year. So, not a red Ferrari, because there's a very
I,
special red
I,
Ferrari that I will never give away. But
I just think it's a rumor, though, you know?
it's a rumor. You never know.
Let's move on to the next slide, if you would. And looks like I'm first on deck tonight to present a stock. I'm going to present a stock that I presented about 7 months ago. And since that time, the stock has been basically flat. It was down a little tiny bit today, which kept it well within the range of the last 6 months. But I think it has a lot of potential, and it's a stock that I own and that's owned in a club or two that I belong to. And so I'm going to present the Ensign Group. Next slide, please. The Ensign Group has businesses in all of the states that are dark blue with the numbers in them. This slide is exactly the same slide that I began my presentation with. I think it was last July, but the numbers have changed on the slide, and we have now added 2 more states, and we've added a dozen or so facilities. We've added a couple thousand beds, and we've added a few more employees to the list. If you're interested in the kinds of businesses that Ensign Group has under their umbrella name, you can see that at the bottom of the slide. 321 of these facilities are skilled nursing home operations. 16 of the facilities are senior living operations. That's much more independent than skilled nursing. 31 of the facilities are campus operations, and those operations not only covered senior living, but they cover assisted living and nursing living and long-term care. And then one of the facilities is directly associated and deals only in long-term acute care. That's what LTAC stands for, long-term acute care. So this is a very varied kind of medical facility, and it's not involved in hospitals or in surgical centers. It's basically in care, human care. Next slide. They have an interesting model. They do not run their facilities individually. Rather, they cluster their facilities by geography, and then the clusters within the geography can share resources, they can share knowledge, they can share sometimes even employees. The clusters are incentive driven so that they tend to compete with each other, and there are different kinds of compensation that are linked to better performance. The cluster basically, however, focuses on best practices and on accountability, on how to evaluate what's happening with those best practices. And they find that it's an extremely efficient way to keep the business model moving forward, and also to reward places where exceptional work is being done when compared to the rest of the cluster or the rest of the company for that matter. Next slide. This company is acquisitive. This is an extremely fractured, a lot of it mom and pop centered industry throughout the country, and they do a lot of acquisition on any given year. They find that after 5 quarters of owning a facility, they've been able to improve their revenues by about 7.5%. After 15 quarters, divide that out, less than 4 years, folks, they're able to improve revenues by over 16%. And by the 45th quarter, that's by just past 11 years of them being in the Ensign Group, they've been able to improve revenues by well over 55%. They feel that they have the expertise to go into very small single or double owned facilities and greatly improve efficiency, revenues, and bottom line EBITDA. So we would want to know how many of their facilities are only about at that 4-year mark and have a lot of room yet to grow revenues and profit. And that's that circle graph up there that you can look at. 2/3 of the facilities are been in Ensign Group for more than 11 years, but about 1/3 of the facilities are either less than 1 year or less than the 15 quarters, less than the 4-year period that they're talking about improving revenues. So about 1/3 of the company has a long way to go, and that set of pie chart right there has stayed consistent for about the last 7 or 8 years. So they're continually adding to the new as some of the new becomes a little bit of the more established parts of the company. Next slide. Ensign Group also contains a fully functioning REIT. A REIT is a real estate investment trust, and REITs by themselves are sometimes extremely profitable. They own the facility, they own the real estate, and then they rent or lease it to other people. The name of the REIT that's entirely within Ensign Group is called Standard Bearer, and the Standard Bearer REIT is responsible for many, many buildings. In fact, if we go to the next slide, we can see where the REIT has their properties. We can see the number of properties in each state. And we can see that about 85% of the properties are not only owned by the Ensign REIT, but they're operated by the Ensign company. So there's not a lot of rent that many of the properties, many of the facilities are paying because the company actually owns the facility. About 15% of the properties in the Standard Bearer REIT are rented by other institutions, other companies, and some of them are not even related directly to healthcare. The real estate value in this REIT's about $1.6 billion, and they're operating almost 15,000 beds or units in 16 states. The lease tenor, what that means is how long does the average lease have before it expires, is about 14 years. And that's a really good number if you look at REITs nationwide, especially healthcare REITs. Next slide. You can see the continued expansion of the real estate portfolio. You can see that it's moving up and to the right. Not much nicer line that you could imagine than that. And again, they're extremely acquisitive, and they have a fantastic amount of experience in increasing revenues and earnings from these acquired properties over time. One more slide, Mark. Standard Bearer has a really strong lease portfolio. Notice that almost 100% of the REITs, of the leases are at least through 2031, the next 5 years. The average is at 14 years, and you can see that we're all the way out to 2040 when we get the high bar on the histogram, and at 2040, about 19% of the current leases will be expiring. Well, that's 15 years away before that happens. This thing in the bottom right corner called tenant rent coverage, you need a benchmark to compare these numbers to, and the benchmark for the average healthcare REIT is tenant rent coverage of 1.2. Let me define tenant rent coverage for you. This number represents how many times the unit, whatever it happens to be, could pay its rent from its current revenues. So in Q3 2025, a typical Ensign affiliated property makes revenue equal to 2.5 times plus its rent. The average number for a healthcare facility, again, is 1.2. So this is considered a very, very good number. In the third party, that's about 15% of the REIT, their average tenant rent coverage is about 1.75, about 1.75, somewhere in that neighborhood. That's still an extremely good number, but when they become Ensign affiliated, the number jumps. Notice the total numbers, they're over 2, and anything over 2 is considered extremely good for tenant rent coverage. Next slide. Here's the visual analysis, up straight and parallel. It's a fairly medium-sized company by the traditional standards. I'm setting growth rates, and this is a typo on my part, Mark. That text box over on the left should read 16% to match what I have in the SSG itself. I'm setting future sales growth at 16% and future earnings growth at 16%. That's well within the data that I found from a number of different sources. And in fact, it's a little bit on the conservative side for the sources that I discovered for this company. Their evaluation of management, these kind of facilities do not make fantastically large margins. They're better margins than a supermarket, but the margins don't come anywhere near what you might find in a software company, for example. Return on equity numbers are good, not superior, but very good with an 18.15-year average. And debt to capital for this very acquisitive company has been trending on the downward side. That's good, but it's still a little bit high. You might ask yourself the question why, and some of that has to do with the fact that some of the properties do carry leases, and therefore if they carry leases, they have to be counted as part of your debt load. That began back in 2019, and you'll see the jump from the numbers prior to 2019 to the numbers post-19, and that had to do with leases. Next slide. I just struck one value. It was a COVID value at the low side of 7.9. And I've suggested a high future 5-year average PE at 30, a low future at 22. Both of those numbers are a little bit higher than the 5-year averages, but I find that the trends have been generally moving upward for the last 10 years, and I'm just continuing that slight movement to the upward direction for the next 5 years. That gives me an average of 26. 30 plus 22 is 52. Divided by 2 is 26. And I think that's a very decent 5-year average. The most recent 5-year average was 24.5. So I am forecasting a slight increase in PE values, not anything extravagant. I'm getting a buy at this price, and the price is slightly lower today. It ended trading today at about $173, so it's $2.50 or thereabouts less than it was when I did the screen capture. That gives me a decent upside downside of 3.5 to 1. Next slide. That gives me return values somewhere between 12 and 15%. That's the way that I read these two values. And that's very close to some of the other estimates for future appreciation for this stock. I did adjust the payout ratio. The company pays a very small dividend. I adjusted the payout ratio to 5% and got a current yield of about 0.1%, a future yield of about 0.2%, a very minimal contribution to the total appreciation. One more slide, Mark. Manifest suggests that this company could give me a par of 14. I think my value between 12 and 15 is certainly in the same neighborhood. So I'm getting some validation for my analysis. And I suggest we add another $1,000 to Ensign Group, and the ticker is ENSG, and they run healthcare facilities for long-term care.
Thanks, Ken. Oh, an old friend.
Yes.
Good stuff.
But we won't worry about the history of Dorman. We'll just say that I decided not to do Gentex again. So we're staying in the automotive disfavored industry or supplier to the industry now. And so we're doing Dorman products, which was featured a couple of months ago by another knight on the round table. And you can see, particularly for a somewhat cyclical business company, at least on revenues, very quite consistent. Earnings per share a little bit less consistent, which again is not unusual for cyclical type companies, but this is something I would consider a slow growing cyclical because it's generally going up. You see the value line potential thoughts on the company, about 30% perhaps over the next year and a half, and then a wide range for long-term prospects between 13 and 25. Next slide. Here is where, well, I guess I should say where I found Dorman was not easy to put onto a chart for this because I decided that I would pick something still in the portfolio, and I was actually looking for attractive stocks in the portfolio that had not been added to a whole lot either. And Dorman fit that, and I considered a few others down in the 1 to 4 or 5,000 value area. And you can see I mentioned Gentex. Gentex, of course, being in the same industry, comes up in this industry study. And doing a quick comparison guide between the two, you see Dorman by manifest numbers has a little bit higher growth rate, a little bit lower PE needed to meet its projections. Gentex has a bit of a yield, which Dorman does not. And again, as of this particular day, about 10 days ago, about 8 days ago, I think it was a week ago yesterday, so Monday last week, a little bit higher potential return, but still Dorman is a very high quality and attractive company in this industry, which is kind of an out of favor industry right now. Next slide. Dorman, the company, has been around for over 100 years. It has been in the vehicle parts business. They design, manufacture, and distribute replacement parts. They sell through all sorts of channels, and we'll see, well, this chart mentions the 3 segments, and we'll see it on the charts, but they have a light duty, a heavy duty, and an ATV or alternative vehicles segments. And they sell retail stores, wholesale to distributors. That's primarily light duty, and then direct to consumer is primarily in the heavy duty segment. But they sell in a number of different ways. And they are a global company, but most of their revenue comes from the US. Next slide. Here's the company saying what they do. This uses some of the same words that I mentioned, but there you can see the light duty, heavy duty, and specialty vehicle sales, and primarily in the light duty, but they, through acquisition, have added the other two segments, and those are smaller parts of the business and perhaps a little bit higher growing, especially in the specialty vehicles, or what I call the alternative vehicles. And then you can see their sales by channel. About half is through retail stores, and then they wholesale a good chunk and then have some direct to consumer. Next slide. Here's what the company says is why we should invest in them, why they are a solid company. They drive innovation. They're seeking to expand their market in a relatively fragmented potential addressable market. They are global and they have a strong financial profile. Next slide. Here's more, excuse me. Here is more of description of the three segments that they are talking about. And these growth rates are not the company's grow, or this is the historical, not the looking forward, and it is the growth for the segment, the market segment. So light duty, not just Dorman, but all light duty has grown at about 4%. And then, as you can see, across the way. And then they talk a bit about particular activities and features in the each of the segments. I won't read them to you, but they're seeking primarily new products in the light duty, as you can see. They are adding an aftermarket segment to the heavy duty sector, and the specialty vehicle, I think, is their newest segment through an acquisition, and they're seeking to continue to grow some by what they're talking about tuck-in acquisitions to help fill out their specialty vehicle areas. Next slide. This just really, it gives you some detail on what the top line says. They do bumper to bumper coverage for all of the vehicles, the light duty, which are primarily motor vehicles, cars and light trucks and SUVs, the heavy duty, which tend to be semis, and then the specialty, which are ATV and similar vehicles. Next slide. And here's how they are growing. Market expansion, future technology. I meant to type in AI, since that's the both the curse and the driver for everything. There you go. Thank you, Mark. They're going to be big in AI, from what I understand. They haven't announced that yet, but you heard it here first. And again, some acquisitions, and probably that's where they'll bring in the AI, is through an acquisition, perhaps of Adobe or Intuit or someone. Well, Intuit, I guess, is going to be put out of business by AI, so you wouldn't want to acquire them. Next slide. Then again, we'll just see a little bit more detail and overview of each of the segments. Again, I won't read them to you, but again, Dorman, and I mentioned it briefly in the in the heavy duty segment a moment ago, but they are in the aftermarket parts business. They don't supply, unlike Gentex, they're not supplying parts to vehicle manufacturers. Dorman supplies parts to owners and operators of vehicles, aftermarket parts. And there's a breakdown. You can see, again, they have some international facilities here, and this is primarily their retail segment. They sell through Dorman stores. Next slide. Then here's the heavy duty, and here, as you can see, they have some direct to consumer, but they're primarily a wholesale distributor for the heavy duty segment. And again, a mixture of both domestic and international. And I didn't mention it on the last slide, but notice that they are adding new products continually. In the last 3 years, over 2,000 new parts they've added to this segment. Next slide. And then here's the specialty vehicle. And as I did mention earlier, this is primarily their direct to consumer segment, where they sell directly to the consumer, with then sales to dealers being a little bit less than half. Next slide. This is from the third quarter report. They just reaffirmed what their guidance was, growth in the 7 to 9% range, which is right in line with my projection, which we'll get to in a moment. And then you can see the earnings per share, and again the disclaimer, if you will, if they had any acquisitions, which they haven't in the last quarter, or divestitures, that could impact their guidance, but they're just about ready to report their final quarter. So there's probably not a whole lot going to change in their guidance. Well, change from their guidance in the actual report. Next slide. Here's my projections. I was right in the middle of their 2025 guidance, but it's in line with history and future projection, about 8%. And this is by the traditional better investing measure, kind of a small, mid-sized company. Annual sales are between 2 and 3 billion. So they're on the smaller end of the mid-size. And then you can see my profit margin projections, roughly the same over the next 5 years as it has been over the last 5 years, a little bit higher. And that leads to a $9.92 EPS, significantly below the manifest consensus projection, and also below the BI median projection for BI members who have done an online stock study for Dorman. Next slide. PEs, here you can see where I use the 5-year average high, which is basically about the same as the 10-year average high, and then I grab the fiscal 24 low to use as my low. So a high PE of 28, low PE of 13. Next slide. And here's our bottom lines. Using a high PE of 28, you can see a potential return of 17.5%, which is kind of in that lower end of the value line range and is a little below little above the manifest par, but using the average PE, which is more along the lines of the way manifest calculations are done using an average PE, you get significantly less. Again, using manifest consensus, we could be very pleasantly surprised with, again, as you saw, a higher EPS and a slightly lower PE projections than I'm using. So I said, let's add another 1,000 to the roundtable portfolio. And Matt, it's all yours.
Thank you, Cy. I didn't even realize this is kind of a rematch between me and Ken. We both first brought these companies in July.
Matt, could I interrupt you for just a second? We do have a hand that's been up for quite a while, and I'm going to allow Pat to speak if she has a question for Cy. Pat, you're self-muted, and you'll need to unmute if you're going to want to ask your question. Pat, I'm going to give you just a couple seconds to unmute, and if not, I'm going to assume it's an inadvertent hand. Patricia Bednars. Okay, I'm going to take her hand down, and I'm sorry, Matt, why don't you go ahead, okay?
No worries. I did also bring this. July, I'll say, was kind of a hurry-up offense. I liked the company a lot, but I'd only done some research. I brought it back in August, really liking it. It since has come down in price from both those months. I do own it, and I still like it even more. Kind of like the other two presentations, some of the basic background of the company I'm going to touch on for one slide, but I'm going to get into some further detail, more forward-looking about the company. So next slide. Vital Farm, I should have put a third egg there. Vital Farms is a public benefit corporation, which means it doesn't just have a profit motive enshrined in its formative documents. It also has two other goals. One is the promotion of family farms in the U.S., and the second one is based on animal welfare. This has been true since the company, it's been true since the company's been public, but it's been part of the company's ethos since it was founded in 2007. I'll leave the rest of this for now. You can refer to the prior 2 months for that. Next slide.
I want to select the too hot section of the country right now.
I'm right there. So the price has dropped quite a bit generally since September, and a lot of what you might read about in researching this industry is about the falling price of commodity eggs. And that's represented on the chart on the left. This is market data from Trading Economics. This is actually a wholesale commodity price for standard large eggs. And eggs have a daily commodity trade, just like corn and wheat and oil. And you can take futures contracts and it moves up and down. You can see a pretty steady decline really since April. On the right-hand side, this is information actually from Cal-Maine Foods, who's the largest egg producer in the industry. They are the primary franchisee of Eggland's Best. They don't own that brand outright, but they have about 75% of that business. In a document they have to explain, as a frequently asked questions, to explain the impact of bird flu. So the data on the right, the data on the left is current as of yesterday. The data on the right only goes through April. They haven't done me the courtesy of updating it, but it's quite fascinating. And explains sort of the other side of the story. So last winter, there was a very severe bird flu epidemic that caused a sharp decline in the laying population and therefore the egg production in the U.S. And the spot market price, the top arrow, the gray line, shot up quite a bit. In Cal-Maine's instance, the conventional eggs, so these are, they don't label them as caged eggs, but they're not cage-free, they're not free-range, and they're not pasture-raised. But eggs that are essentially subject to that spot market price shot up proportionally. What I came away with from this chart was the pink line there, which Cal-Maine has specialty eggs, again, covers all three of those categories as well as organic, moved up a little bit, but stayed fairly steady. And what I found, both as Cal-Maine laid it out, but also in the whole practice of Vital Farms, is their eggs, and in fact specialty eggs in general, are not sold on the spot market, but generally sold on longer term contracts. So in all of the performance that Vital Farms has had this year has not been due to the egg inflation that you'll see here. If it followed markets, the specialty eggs would have been much cheaper than conventional eggs, and you didn't see that at the retail level. So I'll show more on the downside of that coming through, or I'll say as the prices have gone down. But one thing to note that even after August is the shares sold short as a percentage of the float of the company is at a very high 28.3%. Cal-Maine's also increased during this time that eggs went down. I think they're about 10%. They're a much larger company, but quite high. So you would think at that level that this company would be near bankruptcy or having severe financial problems to not be a going concern. And so it only takes proving that they're doing fine, and then that word getting out to undo those trades. That's sort of potential energy stored in the stock price now. Next page. So this is a slide from Vital Farms' latest investor day, which was done on December 16th. And I loved this section. They are in most of the major supermarkets and hypermarkets in the US. They actually named a number of things. They had several slides about the relationship with Kroger. They also had a specific example with Publix and with Target. But one of the things I think, and you mentioned it just in terms of thin margins, right? So grocery stores have the thinnest margins around. You're only going to make 1 or 2% on any sale. How do you make a lot of money then? You sell a lot of things. You turn your working capital over many times so that in a period of a week or period of a month, you've gotten a lot of those 1%. So grocery stores love and call this velocity. That's what the red bars measure, and the unit of measure is esoteric, I'll say at this level. But to say Vital Farms has the highest velocity of branded eggs at Kroger, and is number 1 or number 2 in all of the top 10 customers that they have. The point of this chart is to give some counter evidence or give some actual evidence to a narrative that I believe drives the shorting, that as the price of traditional eggs goes down, the demand for specialty eggs will go down. This is a short-term test. The bars represent a week, but what's happened is Kroger put an 18 count of eggs. These are traditional large eggs on sale for a week. They're normally $3. They were put on sale for $1.99. The Vital Farms price was stayed steady at $7 a dozen. Again, that there's many different kinds there, but roughly $7 a dozen. And the point of this is that even though traditional eggs were put on to a price where they were a loss for Kroger, so what's called a loss leader, that did not attract or detract from Vital Farms demand. It's different levels of customers who are attracted to the loss leader, where the grocery store might then pick up their margin on the cake mix you use or the meat and veg you're going to put with your omelet, as opposed to someone shopping for Vital Farms for eggs that they value and other things they value. This is the kind of behavior that I think was in play, or that the people short the company don't understand, because they expect that as commodity egg prices were inflated, so were specialty eggs. And that's true at the retail level. Why was that true at the retail level? Because eggs were so expensive that to offer them at any price, they were all loss leaders. So their customers, Vital Farms customers, are actually depending on the margin of their eggs to offset sale prices, certainly within the category of eggs, but also elsewhere. And I think that alignment is very important, along with the alignment that they have with their farm suppliers who they also have on long-term contracts to have the company run smoothly year over year as long as demand is present. So it was very interesting to see this inside baseball, if you will, of egg marketing at the grocery store level. Next page. This is a slide from Cal-Maine. This is just to point out, as I said, Cal-Maine delivers traditional eggs and specialty eggs. It's about 2/3 traditional, 1/3 specialty. And they note, because it's a higher margin for them, that specialty eggs have grown 100% from the period of 2019 to 2025 as a percent of the overall egg market. Just to say, Vital Farms is actually growing faster than this segment is growing overall. Next page. So the other part of the story in terms of egg prices being low is bird flu. We don't hear about bird flu, certainly not that we did in 2022. So is it gone? Is it done? Is it a thing? Well, understand that bird flu, just like human flu, is a seasonal item. So we're just getting into the seasons. And in fact, the snippet from Trading Economics here is the top of the page of the graph from a couple pages ago, where the USDA notes there are outbreaks of highly pathogenic avian influenza at a number of major U.S. producing states and as well in Europe. So there always is a threat of bird flu. The chart on the right is analogous to the blue line from the chart a couple pages ago. This is the total laying population in the U.S. The USDA tracks that. And understand that even as we have recovered from the extreme lows of early last year, we are still below the level that the bird population dropped to initially in January 2022. So we are in a moderate threat level. Bird flu is relatively contained, but it's always a problem, and it's a problem because of industrial growth of chickens and laying eggs. The average facility that Cal-Maine has 6 million laying hens per facility. Vital Farms and its support of family farms on the lower left shows that they have a very distributed locations. They have, for the 10 million birds they have in total, those are spread across 575 farms. It's not the reason they do it, but it so happens that geographic diversity it makes them naturally resilient to future bird flu shocks. Next page. And then finally, it's not about the eggs, or it's not just about the eggs. So we'll talk about, when we get to the SSG, Vital Farms has grown quite a bit and has a clear growth trajectory for eggs through 2030. But is it a growth stock after that, or is it going to be topped out? This slide dates from their first Investor Day in 2021, a year after their IPO, at which point they stated eggs are not the only thing they're going after. They have a number of adjacent categories that they clearly see they can go to, and understand they've built not just an egg distribution machine, they've built a distribution platform for hundreds of family farms. And those farms are not egg farms per se. They're diversified farms, and a number of farms only started growing eggs for Vital Farms. So there's a very large opportunity in other categories that also exist. Certainly cheese is an important part, another dairy, charcuterie or other meats, and even fresh vegetables, that they could take their trusted brand, their existing supply base, a different sort of processing level, and then the same distribution because it's all refrigerated, and go to different categories across here. In 2021, Vital Farms, in the red and below, stated this was a potential $4 billion revenue opportunity if they had the same market share as they did that year. That year they had $261 million of revenue. They'll have $760 million this year. So they are growing their market share in their current category. They're much bigger, and so their reach into retail and other ways to extend their reach has made this potential even bigger. Next page. Finally, Value Line actually got on board. I was a little, Vital Farms just got on the Value Line Standard Edition in July, just days before I started researching it. So this is in October was the second, and January is the third value line that's come through. I was a little perturbed that the October value line did not recognize a lot of Vital Farms revenue growth potential. They have since rectified that. They're still quite conservative, honestly, but they're fairly in line. And just at the end, some editor at Value Line is going to really feel sheepish because on the Value Line page, and only the Value Line page, not in the data, it's still titled as Vital Foods, but even though the headlines say Vital Farms. So you're in the right spot, ticker VITL. Next page. All right, so getting into the SSG, this is an updated build from the SSGs I've shared before. I have struck out a few years. The company is investing to rapidly grow its business and doing that out of cash. So their earnings do get a little choppy, but their revenue is quite straight on. I have some sales and EPS estimates in there. None of those come with the SSG. The first three for 25, 26, and 27 are based on company estimates. In fact, 2027, which looks below trend, is the old company estimate of $1 billion by 2027. You can see how much they've overachieved that or plan to overachieve that now. The 2029 line is from the current value line. So I'm right on with them for revenue. I think they can do a little bit better for earnings per share, but that's the value line source. It's nice to have them there. So I'm projecting 26% sales growth. Now this is, again, it just shows 2024. So from 2024 numbers, they've committed to 21% growth, but they said that just after they proved that they've beat every commitment they've made since IPO. And then a slight, not a large, but a slight leverage of that on earnings per share, certainly with better operating margins, but they do issue stock options to their employees, so there will be some stock dilution. Next page. Sections 2 and 3, I won't talk too much about it, only to say, some may find this, and certainly I would call it non-core at this point. It's a company that's taking off and has only had sort of the metrics that we really would like to see for a couple of years. But in particular to note, this is a company that has doubled and will double again its capacity, and is not doing that out of debt financing almost at all. It's out of cash generation. That's amazing in a food company. Section 3, the PE ratios are a little challenging. The low isn't too bad. Obviously, in those early years that were bumping, I crossed out anyway. They're kind of ridiculous. There is a little bit of contraction, somewhat in the high PEs, but it's really just varying between 30 and 40 quite a bit. So we'll split the average in the next slide. So section 4, you might not be comfortable with this. I'm saying a high PE of 35. That's right in line with the average high. And then the earnings per share is what it is. It's 134.40. Selected low price is actually 30% below the current price. We're almost at a 52-week low right now. So that can get kind of sticky, but the A version works out okay. There's a buy zone here, and the upside downside ratio, something that we caution our learners never to do, of 12.8 to 1. The market doesn't usually give you those kinds of things unless we're in a March of 2020 COVID shutdown situation. So we need to ask ourselves, is this going to be a growth company in 5 years after it's fully used the capacity it's making? Again, my confidence in that is all of the categories they're not in yet. Actually pretty blue water going forward. And then the other one is the low price low enough. Again, the low price is a 30% drop from here, already a 52-week low. I can get an upside downside ratio around 4 if I put the low price at 0. Again, as if I was one of those shorts thinking that for some reason this company is really in trouble and might go belly up. I could still see a very good reason to buy, and that's not at all the case. Next page, last one. So again, super high. You can be much more conservative than this and still like the company. I will say, and I didn't put it on here, So I get a par, that's the second compound annual return using the average P of 28.1. Manifest today is 27.8. So we're along with it. So super bargain price. Just waiting for news of normalcy in earnings to hopefully send some shorts to the exits for a nice quick bump back to what was normal this summer, and then hopefully steady growth for the next 5 years. Is there something else I can say? I think that's good enough. That's Vital Farms.
Good stuff. Yeah, for those of you that may not be familiar with the concept of shorting, it's like us standing on our heads and doing everything exactly the opposite, expecting bad things and bad returns, and basically betting against the stock. So they basically sell stock they don't own, knowing that they will have to buy it back. If they are wrong, that can lead to what is known as a short squeeze, and that's what Matt is probably hoping for every day when he gets out of bed.
Oh, I remember what I was going to say. They have not announced when their 2025 earnings will be. Last year was February 27th. So we probably have to while our time away for a month or so till we get some more news.
We can do that. All right, just a quick moment with the cash flow aristocrats. Again, these are companies that have had increased cash flow for the preceding 10 years. Somebody was asking about Intuit. It's right here near the top of this list, but any of these companies at the top, I would be careful to understand the full story. A number of these companies are either in the roundtable tracking portfolio or are fairly recent additions. So I think it's a pretty decent place to go shopping. I'm going to spend some time talking about, I'm going to borrow some slides from today's bull session, actually last week's bull session, and kind of just go through and give you a couple shopping lists. This happens to be a look at the highest. I'm going bottom fishing here. I'm going looking for companies that have extremely high value line average return forecasts. You can see the low and high price forecasts, and from top to bottom, those are some pretty robust returns. I would love to find a company that really caught my attention and imagination. Not many of them do. These numbers are really getting almost speculative, and Ken is chuckling about the word almost in there. Flowers Food has been around a bit. It's got a little bit higher quality rating. Down here, the Trade Desk is a company that I have paid some attention to, and advertising is an area that makes a lot of sense. And then all the way down to the best car company in the state of Michigan, Stellantis, is on the list. So just some places to look. Here's a quick look at the Trade Desk. Again, fairly decent story. I would be slightly concerned about the flatness of earnings expectations here. A little bit concerned about that dot right there. Is there a projected drop-off in business? And yes, the quality trend is down. Very high growth rates, high profitability, decent projected average PE ratio, but again, single digits here. So let's go on. Flowers Foods. You're probably a customer of Flowers Food. They're the number 2 producer of packaged bakery foods. The thing I don't like here, although this is parallel and it's up, but it's pretty flat. 4% growth is probably not enough to keep me out of trouble with Ken. So I don't want to add a 4% grower to the portfolio, even though the projected return is up here. If you're a person looking for a conservative growth company that has long-term positive attributes, this could be attractive. But for our portfolio, maybe not so much at this time. You can see the projected return somewhere in the mid-teens. So, and you can see there's a pretty good price drop right here for whatever reason. Dig in and figure out that reason and decide for yourself. Plain awesome. It's Dave's Killer Bread. So then I said, all right, let's go shopping in the complete set of stocks out there. I want a excellent quality company, greater than 80. I want a par, greater than 13, but not too high. Don't want to get greedy. I love B++ and better financial strength companies, and then I want double-digit growth to keep Ken happy. And you end up with this list. Some of these we've already talked about. Coinbase kind of jumps a little bit. There's a lot of turmoil in the crypto and and Bitcoin markets, but that could be interesting. Could be worth scratching a head over. We've already talked a little bit about these two. Oracle is a company I'm extremely familiar with, having worked in that realm a little bit. And then a number of other companies. Brown is on here. By the way, here's Ken's Ensign Group. Brown's a recent addition to the portfolio. Here is Ken's United Therapeutics. And again, a number of companies. Schwab, community favorite. And here's another Ken company. So we know where Ken does his shopping. Good quality growth stocks kind of is his mantra. Mantra? Coinbase, not ready for that right now. Yeah, there's some question marks here. There's a whole lot of turbulence. I'm not sure what to believe. I mean, this is cool, but I'm not sure what to think about it. Quality exploding. It's a fascinating area. Pat Donnelly featured this in one of our panel sessions a couple years ago, so he's probably doing okay. But nah, not right now. Leaves us with Oracle. Oracle, fairly consistent company over the long term, very respected information technology consultant and software company. Somebody towel off Cy Lynch because this is kind of up his alley. Again, very respected, not inexpensive in terms of their product and services, but they've been around for a long time and they have a very robust list of customers that they're likely to figure out how to hang on to. Basically, what you're looking at is a company growing at 20%, which is very strong for a company in their realm. Their projected net margin in the low to mid 20s. Again, pretty straight earnings per share trend. You can see that the earnings per share stability or predictability is quite strong. They have come back fairly significantly in stock price. We're going to talk about that. Projected average PE of about 26, again, places you somewhere in the mid-teens. That certainly qualifies with respect to the average stock being right now right in that 8% range for the return forecast. So good stuff here. Here's kind of the opportunity. They are involved in data centers and consulting for AI type companies and virtually any type of company. Most of the S&P 500 or the Fortune 500 has engaged them in one way or another at one point over time. And they basically ran up on the euphoria associated with AI and the data centers. You can see they got up to nearly 350, and that's been kind of cut in half. Just people wondering, were they a little bit optimistic? So I see that as a potential buying opportunity. You can see that the relative strength index is as low as it's been for the last 10 years. So that is kind of an attractive condition if the wheels aren't coming off and if the lug nuts are not coming loose on the company. So here's just a quick summary, courtesy of Morningstar. Usually when I was presenting to my investment club, if I wanted to discourage an investment, perhaps a nomination that someone else had made, I would just repeat the bear column in the club meetings. And then if I wanted to focus on getting my nomination voted for, I would just read the bulls. But let's do editorial balance here. You can read either of the two columns. Some legitimate concerns and legitimate opportunity is basically laying right there in front of you. And it's, again, very established company that does quality work and is pervasive throughout many, many realms of the industry. The one that I do find interesting is down the comment made on the lower right. The balance sheet is pretty leveraged. I didn't think that was true, or I was skeptical about it. And so I took a quick look at, what is the situation? Well, they do have $100 billion in debt. That actually does rank pretty highly. One of the ways we look at the debt characteristics of a company is first ask, well, what are they paying for an interest rate? They're fine in that regard. They're paying under 4% for their mortgage, if that's the way you want to think about it. But when you start looking at this number and how it stacks up versus other companies, that's a pretty high number. It's the same way you might think of when you went shopping for your first house, and the banker looked across the desk at you and said, well, how much money do you make? And basically they do a debt to income pre-qualification for real estate. Same type of thing. They do have a relatively high debt load for not just their industry, but all companies in general. So that's a fair statement. They are leveraged up. So with that, I do think the company has a lot of potential. That price dive does present an opportunity, and I'm going to recommend that we take a position in Oracle and hope that they are as rewarding several years from now as Microsoft has been for us over the last several years. So Ken, I think we're ready to go to a poll.
And here it comes, Mark. We'd love for you to tell us which one you'd like to put some money into, and we'll take $1,000 in roundtable money and put it into the audience choice, as well as $1,000 for each one of our presentations in roundtable money. We have 2/3 of you voting. I'd love to get it up to 85 or 90% if we could. Three-quarters of you have voted now. Mark and Cy and Matt and myself, we don't get to vote. So when you get a chance to vote, vote, folks, okay?
Doesn't seem fair.
We're a couple of votes away from 80%. Doesn't cost you anything, folks. Just press a button. Just make a choice. Take a risk.
We have 8% for none of the above.
I'm going to count backwards to 10. It's your last chance, folks. Help us out. This is a low vote tonight, folks. We must have a lot of new people that think we can figure out what you voted for. We don't have any idea what anybody voted for.
That's
so
what he says.
We're not going to offend anybody.
The 8% are the shorts, Mark.
I'm going to close the. All the hecklers have to be quiet, okay?
Okay, we're quiet now.
The poll and share the results. And Matt's Vital Farm nudges out Ensign Group in second place. Dorman takes third, and Oracle is fourth. That is a large none of the above. Some of the folks didn't like any of the stocks tonight, Mark, okay? So with that, let's go back.
Well,
and I'll hide this so you can go on to our next slide, Mark.
All right, are we showing?
We're showing the YouTube now.
All right, we do archive all of these presentations on YouTube. You can see former roundtables from November and December on here, along with our weekly bull sessions that we do Tuesdays at 2 o'clock. And then those three sessions up above that have the Mackinac Bridge in Michigan on them is that 3-part series on portfolio management that we had talked about. Session number 3 is actually a walk through 18 different investment clubs in their portfolios. So it was a fun day on Saturday, and people seem to enjoy it. Just a quick reminder that we do our bull sessions Tuesdays at 2. If you want to kick back and talk about investing related stuff with us, it's a good time. There's a breakfast club that takes place tomorrow morning at 9 o'clock at the Heart of Illinois. You can go to the Heart of Illinois chapter on the Better Investing website and get access to that regular event. Our February roundtable will be our award show 3 weeks from today. And then we'll add a few more events on here. We do have a number of commitments that we have made that I need to put on here, Ken, but I just got lazy or busy, one or the other. And the National Convention, just a quick reminder, I think you can still get it before the price goes up a little bit here in the next few days.
Yeah, there is a Valentine's Day.
Matt has it there. Say it, Matt, again, so I don't overlap you.
Yeah, there is a Valentine's Day special currently.
Okay.
Which is not quite as good as Christmas, but it's great.
All right. And all of us that you
bring your lovers.
It should be a 2-for-1. I mean, if you're going to
Yeah.
call it.
Yeah, it should be.
Take that discussion offline, gentlemen. Okay.
Yeah, I was just trying to figure out where I could go with that without getting in trouble, and I haven't figured it
Yeah,
out yet. I'll leave it
nowhere,
alone.
Mark. So just keep going here.
April
Okay.
23rd through the 26th in Chicago, and it will be a good time. Absolutely.
We should start mentioning also that after the convention, Mark and I are going to be visiting Oklahoma City, and we'll get that on here in the next by the next roundtable, so that you can see the dates on Oklahoma City.
Yep.
So, Mark, we've kept up with the questions pretty well, and if there's nothing else, I want to thank all the knights tonight. We're in a kind of timely fashion this evening. We're finishing just maybe a couple minutes past where we anticipated. So I want to wish everybody a great winter. I'm kind of happy to see that the rest of the country, or at least a lot of it on this side of the Mississippi, has begun to experience a little bit of winter. So that's a good feeling from my point of view.
You know what's really good for harsh winter conditions?
What, Mark?
Scrambled eggs from Vital Farms.
Scrambled eggs, okay, and maybe bacon in the near future, okay.
Absolutely, get out there and buy those Vital Farms products. I want to see Matt experience a short squeeze.
So,
Did Mark vote somehow or nothing? He's
okay,
over my set already.
I'm going to call it a night, guys. All right. Thank you for coming, folks. You're the reason we do this, and we do it as long as we enjoy it, and I think we all enjoyed this evening. Good night, everybody, and have a good 3 weeks until the next roundtable.
All right.
Good night, all.
Bye, everyone.